Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AMD, a company that has been fundamentally redefining the landscape of high-performance computing and artificial intelligence.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We have to start this conversation, immediately with the money story, because the recent Q3 2025 financial performance for AMD was nothing short of spectacular.
Okay, let's break that down, because in this industry, 10, maybe 15% year-over-year growth is solid.
Right.
But the top line numbers for Q3 were, well, they were immense. A record quarterly revenue hitting $9.2 billion.
And that represents a robust 36% year-over-year surge.
Which is already impressive, but I think the real story is how that growth flowed, down the income statement.
Exactly. It's the quality of the revenue growth that really transforms the investment thesis here. Just look at the margin story. Gross profit grew 40% year-over-year.
So it's actually outpacing revenue growth.
Precisely, which led to a margin expansion that clocked in at 52%. That $500 million increase in gross profit, it tells you they are gaining massive efficiencies on every single chip they sell.
But nothing, and I mean nothing, compares to that net income figure. A massive 152% increase year over year, reaching $1.2 billion.
Yeah.
When a company posts a number like that, the first question for investors has to be how? How do you generate that level of operational leverage? Is this just a flash in the pan? Or are the fundamentals structurally healthy enough to support this jump?
It is structural. And it's a classic case of their high-performance computing strategy finally hitting a kind of critical mass. Operational leverage happens when your fixed costs, things like R&D, which are incredibly high for developing EPYC server chips or Instinct accelerators, they stay pretty constant.
Right. The investment is already sunk.
Exactly. But your unit volumes just increase drastically. And since the average selling price of a data center chip is so much higher than a consumer chip, every new server rack they fill is just pure profit flowing straight through. This is sustained efficiency driven by scale.
That makes perfect sense. The floodgates are just opening on the volume side. Okay, so shifting to the balance sheet, a 152% net income surge. That usually makes me worry about a company over-leveraging to fuel growth. Are they financially stretched?
No, actually quite the opposite. Their financial health is confirmed by a very strong balance sheet. They have a low debt-to-equity ratio.
And in an industry defined by massive capital expenditures, that's crucial.
It gives them so much strategic flexibility, which is critical when you're battling giants in the AI space.
So what's management doing with all that free cash flow? Are they just sitting on it?
No, they are being extremely proactive. Management is guiding that cash directly back into, further investment in high-performance computing and, crucially, next-gen AI infrastructure.
So they're reinforcing the moat they just built.
They're ensuring long-term resilience by pumping money back into R&D. And importantly, their guidance for Q4 2025 is still extremely positive. They're forecasting continued momentum across all their key lines, EPYC, Ryzen, and those absolutely critical Instinct AI accelerators.
Okay, so the books are healthy, the profit engine is humming, but, in the hyper-competitive semiconductor world, you need more than just good quarters. You need a strategic narrative. What's the why behind this acceleration?
The clear singular driver is their aggressive positioning in the data center and AI market. Leadership, really. And the biggest strategic move announced late in 2025 was that high-profile partnership with OpenAI.
Right.
This isn't just a supplier deal. This is seen as a genuinely transformative relationship.
Transformative how? I feel like that phrase gets thrown around a lot.
Well, because it positions AMD for a potential opportunity of, and I'm quoting here, tens of billions in incremental revenue over time.
Tens of billions.
We have to contextualize that.
Yeah.
We're not talking about selling a few thousand chips. We're talking about providing the critical, scalable hardware needed for these massive, power-hungry generative AI workloads, the ones that underpin services like ChatGPT.
So it's a huge vote of confidence. That kind of validation secures a significant pipeline for future revenue.
It does. It's a powerful engine for sure.
Okay.
But to your earlier point, they are building a sustainable moat beyond just that single deal.
How so?
Through product breadth and smart acquisitions. Their portfolio EPYC, Instinct GPUs, high-end Ryzen chips, it lets them hit multiple market segments at once. The AI and data center business is scaling aggressively, creating a kind of network effect.
And speaking of scaling, I saw some news about a major asset acquisition. What was the thinking there?
Right. They made two critical moves. First, the acquisition of ZT Systems. This was specifically designed to accelerate AI infrastructure deployment for those hyperscale cloud providers. The Amazons and Googles of the world. They're buying expertise and capacity.
And the other side of that was a massive liquidity boost, right? Selling off the ZT Group international assets.
Precisely. They completed the sale of those non-core assets to Sanmina. That deal secured a huge $2.4 billion in cash, plus potential contingent payments in stock.
Wow, so that's a huge infusion.
It not only streamlines their portfolio, focusing them on high-margin compute and AI, but it also gives them a ton of cash on hand, money that can be used for R&D or more strategic acquisitions to stay ahead in the AI arms race.
Okay, so if the fundamentals are this strong, how is the technical picture validating the story? The stock has had an incredible year, up about 113% year to date as of late October.
It's been an amazing run.
So when you see a stock run this hard, everyone asks, have I missed the train? Let's look at the chart to see if there's still room on board.
Well, that 113% run, it reflects an established healthy trend. It's not a flash bubble. The price action confirms a sustained uptrend, consistently setting higher lows and higher highs all through 2025.
And if we're looking at tactical levels for someone holding or maybe considering an entry, where should we be focused for support and resistance?
Okay, so near term, immediate support looks to be right around $249, which often lines up with the 10-day moving average, a key psychological level.
And for more significant support?
You look down around 237. That's a major area where you see multiple longer-term moving averages intersecting. If there's a dip, that's where you'd expect institutional buyers to step in.
Okay, and on the upside, what level would trigger that next stage of momentum?
On the resistance side, you want to watch 268. That's been tested before. But if the price can clear 275, that's the level we'll be watching for intensifying momentum. That would suggest the market is pricing in that Q4 AI acceleration faster than we thought.
And what about momentum indicators? Is the run overheated? Has the market gotten ahead of itself?
Not necessarily. The price is comfortably above all the major moving averages, and they're stacked bullishly. Crucially, if you look at the relative strength index, the RSI, it's strong at 68.9.
So it's just under 70.
Exactly. An RSI near 70 means the stock is highly valued, yes, but staying just below that key 70 mark suggests institutional money is still comfortable buying and accumulating. It's not signaling it's grossly overbought. It shows sustained strength, not exhaustion.
And that technical strength is clearly being validated by the institutional side, too. We've seen strong inflows in Q3, and the street is adjusting its targets fast.
Absolutely. We've seen major banks like HSBC and Bank of America raising their price targets to 310 and 300, respectively. And they aren't just reacting to past earnings. They're responding to the accelerating momentum from AI hardware demand.
So we have strong technicals built on strong earnings and a compelling strategy. Let's look forward. What specific events could drive the stock price in the next 3 months? What dates should be on the calendar?
The biggest one, I think, has to be Q4 earnings. That'll be late January or early February 2026. Management already guided for continued record results, especially in data center and AI. If they meet or beat those high expectations, that could be a powerful catalyst.
And of course, early January brings CES 2026, which is always a massive launch pad for the tech sector.
That's a crucial industry event. Observers are expecting, potential reveals on new EPYC and Instinct hardware roadmaps. If they announce performance benchmarks that directly challenge their competitors or reveal more partnerships, that will drive short-term momentum.
And beyond products, there's a key structural change coming up, the segment restructuring plan for December 27th, 2025.
Right, and that's significant because it changes how the company reports its consumer businesses. They're merging the client, which is PC processors, and the gaming units.
Why are they doing that?
The goal is twofold. First, improve operational efficiency. And second, to give investors a new integrated view to benchmark their combined consumer performance. It could help investors focus even more on the high-growth data center and embedded segments.
What about rumors? Any credible speculation floating around that could act as a near-term catalyst?
There is persistent, credible buzz about further AI superchip partnerships building on that OpenAI validation. And also, whispers about launches of next-gen accelerators designed specifically for large language model inference workloads.
Okay, for listeners who might not be deep in the AI jargon, what's inference and why is that so important?
So training an AI model, that's the initial high-cost part. Inference is the process of actually running those models to generate responses. That's the day-to-day operational cost.
Got it.
So if AMD can launch accelerators that are way more power efficient or cost-effective for high-volume inference, they would unlock a huge market opportunity. They could challenge the leaders not just in training, but in the day-to-day execution space too.
We've painted a very bullish picture, but every high-growth, high-momentum company carries risks. We need a reality check. What headwinds is AMD navigating right now?
Well, we have to start with competitive pressure, particularly from NVIDIA.
The elephant in the room.
Right. While AMD is gaining AI momentum, the race for market share is just brutal.
Mhm.
Execution risk is also paramount. Scaling manufacturing for these complex accelerators is incredibly difficult, and the risk of delays is always present.
And you can't ignore the macro environment either. Geopolitical and regulatory risk must be a factor, especially with U.S. export controls on advanced semiconductors.
Absolutely. That need for ongoing adaptation is a constant challenge. They have to make sure their highest-end chips can be sold globally while complying with constantly changing U.S. export restrictions. That directly impacts their revenue potential.
And finally, the overall cycle. Semiconductors are notoriously cyclical. Does the strong data center story make them immune to a broader tech downturn?
Not immune, no, but resilient. The company has successfully outperformed its peers during downturns in 2025, largely because of that diversified portfolio and, the insatiable demand for AI compute. The long-term structural AI growth story provides a strong buffer, supporting both short-term trading and long-term holds.
That provides great context. So the financial strength is converting directly into strategic AI engagement.
I think the real question for investors moving forward is not whether they can grow, but whether they can maintain the profitability profile they just established. I'm fending off competition and managing global chip fabrication capacity. If capacity finally catches up to demand next year, you could see unexpected downward pressure on pricing. That's the crucial metric to watch moving forward.